Welcome to the Deep Dive. Today, we're taking a look under the hood, really, something happening kind of behind the scenes. We're talking about the future plumbing of finance, specifically this company, Metallicus. And what they're building, they call it the digital banking network. Our mission, basically, is to get a handle on how this whole thing works, how traditional finance, the big banks, credit unions can finally mesh with digital assets, DeFi, but in a way that's, well, compliant. Scalable. And compliant is the key word there. Exactly. This isn't just theory, it's actual infrastructure going live.
And I think the absolute core idea right from the start is that Metallicus isn't trying to fight the banks, they're building for them. For banks, credit unions, fintechs, they're laying the tracks for a system where every single institution can eventually issue its own branded stablecoin. Fully compliant, interacting seamlessly.
Okay, that framing is critical. Not disruption, but enablement. That makes sense. But for banks to buy in, the foundation needs to be rock solid. So let's break down this architecture. Starting at the bottom, layer 0, the sources call it the metal blockchain. Why layer 0? What's the deal with it being US built? Does that give it some kind of edge?
Yeah, that's definitely the place to start. I mean, look at most public blockchains. Where are they based? Who governs them? It's often murky. And for a major bank, that's just a complete non-starter. Metal blockchain tackles this head on. It's US built. Its whole consensus setup was designed specifically with compliance and security in mind, not bolted on later.
Okay. So it's built for purpose.
Right. And functionally, this L0, think of it like a master security layer. It lets institutions spin up their own private subnets, their own stablecoins, digital ledgers. It's like giving each bank its own super secure private network, but all underpinned by the same shared compliant L0 security.
Like private lanes on a secure highway.
Exactly. The sources actually call it the Internet of Compliant Blockchains. It lets you enforce rules locally, keep data private, while the whole system stays secure globally.
Okay, so L0 is security, jurisdiction, kind of the walled garden banks need. But gardens don't move money between each other easily. So moving up, layer 1, the XPR network. How does that connect these secure L0 subnets without messing up the compliance?
Right. So the XPR network, layer 1, that's the main settlement hub. This is where the speed happens. If L0 is the secure foundation, L1 is the superhighway. Payments, DeFi stuff, asset transfers, it all flows through XPR. It connects all those different L0 subnets, lets them transact instantly.
And that's where this metal dollar comes in, the SexMD.
Precisely. That's the key piece for interoperability. And the source defines SexMD very specifically. It's not just a stablecoin, it's a multi-asset stablecoin basket.
Okay, hang on. A basket. That sounds important. If Bank A has its own coin on its L0 subnet and Credit Union B has its coin on another, how does this SexMD basket stop it all from becoming a mess of different prices and locked up liquidity? Is it kind of like the IMF's SDR thing?
That's actually a really good analogy. Yeah, think of XMD like a central clearing mechanism, but for stablecoins. Normally, yeah, you'd have dozens of incompatible bank coins, a fragmented nightmare. SexMD acts as the standard. It links all those different institution-issued stablecoins into one framework, compliant, interoperable.
So value moves through SexMD.
Exactly. A bank wants to send value to a credit union on a different subnet. They don't worry about coin A versus coin B. They route it via SexMD. The basket mechanism smooths out volatility, ensures instant standard exchange across the whole network. It really is that digital bridge. TradFi rigor, DeFi speed, standardized settlement.
Wow, okay. That structural guarantee, that's huge. It means a bank launches its digital dollar and boom, it's instantly connected to this whole compliant ecosystem. All right, architecture and bridge check. Now, utility. What can you do on this network right away? Beyond just moving money, the sources mention lending pretty prominently. The LOAN protocol.
Yeah, and LOAN immediately shows why having compliance baked in at layer 0 is so powerful. Because you know who everyone is, thanks to identity verification, which will get to the usual risks in lending and borrowing. They're massively reduced compared to, anonymous DeFi.
Makes sense. Less risky.
So LOAN enables instant lending, borrowing, collateralized positions, yield generation, all across the network, fast. But the crucial difference is, because the whole thing is identity verified and governed, you get things like instant collateral settlement, compliant liquidations, stuff traditional finance absolutely needs.
So it's DeFi efficiency, but without the Wild West risks.
You got it. It's an immediate tool for institutional treasuries, ready to deploy.
Okay, utility makes sense. Now, who's actually driving this thing? Governance. We see mentions of an MTL token and something called the Metal DAO. How does that work?
Governance is vital, right?
Yeah.
Especially with banks involved. The MTL token is the tool for that. Through the Metal DAO, the token holders, they actually have real influence over the network's direction. It's described as the heartbeat of decentralized governance.
Okay, but influence can mean a lot of things. Is it just voting on minor stuff or real decisions like what?
No, these are pretty major strategic choices. For example, the DAO votes on proposals to create new subnets. So they're deciding if and how the network should expand for, say, a new type of financial institution or use case.
Oh, yeah.
They also direct ecosystem grants, deciding which developers or fintechs get funding to build on the network. And they control treasury allocations.
So real control over strategy and funding.
Definitely. It's not just for show. It's actual decentralized control over how the infrastructure evolves and gets paid for.
All right, this brings us to the absolute crunch point for any bank or credit union. Compliance. We keep saying the word, but for a big institution, compliance means ticking specific boxes, meeting concrete standards. Why this system over their old, creaking legacy tech? You said it before, compliance isn't optional here. It's built in. How?
Absolutely fundamental. A chief compliance officer needs to see proof. And Metallicus points to specific technical alignments in the sources. The big one is ISO 2022 alignment.
ISO 2022. Now wait, isn't that the old Swift messaging thing? Why does a blockchain need that?
It is, yeah, but it's becoming the global standard for rich financial messaging. It's not just about sending money, it's about sending the data with it. Data needed for complex compliance, sanctions checks, regulatory reporting, all that stuff. By building the Metal blockchain to be ISO 2022 compliant, they ensure that every single transaction, even a super fast stablecoin payment, carries that rich, standardized metadata regulators demand.
So the blockchain speaks the same language as the global banking system.
Essentially, yes. It makes it understandable, digestible for existing bank systems and regulators. That's layer 1 of compliance. Layer 2 is identity. Every account uses weboff.com identity-verified wallets. These are the gatekeepers.
Identity verified, so KYCML built right in.
Exactly. Before you can do anything significant on the network, your identity, whether you're a bank or an individual, has been verified. Proper standards, no anonymous actors.
Okay, so if L0 is security, L1 XMD is the bridge, then these WebAuth wallets are the compliance guards at the gate. That's the DeFi with guardrails idea. How does that stop the bad stuff we see in DeFi sometimes, but keep the speed?
Well, the verification is upfront. Instantaneous, basically, when you onboard. So much risk in traditional DeFi comes from anonymity, right? No recourse. By mandating identity verification for every wallet, you bring that discipline of traditional finance directly onto the blockchain from the start.
But it doesn't slow things down.
No, because the check is done at the source. You keep the speed, the efficiency of blockchain settlement, but you strip out the anonymity risk that regulators hate. It gives institutions confidence, allows money to move frictionlessly cross-border, faster settlement, because compliance is sort of automatic, baked in from account creation.
Right. Okay. Zooming out. Connect the dots. Layer 0 security, XPR Layer 1 settlement, SexMD bridging, WebAuth identity for compliance. It really does paint a picture of this unified digital banking network. Banks, credit unions, fintechs, all plugged into the same foundation, letting finance actually move at internet speed without the old correspondent banking clunkiness. So let's wrap this deep dive. The big takeaway for you listening, I think, is that strategic shift. It's not about tech does versus banks anymore. It's about building the rails for the banks. Compliant rails, identity verified rails, standardized rails.
Precisely. We've hopefully sketched out that layered system now, the Metal blockchain L0 for security and jurisdiction, the XPR Network L1 settlement hub, and that absolutely vital bridge, the SexMD multi-asset basket, making it all work together. It's an ecosystem designed for integration, not isolation.
So building on that, here's the final thought for you to chew on. If every major bank, every credit union, can issue its own compliant, branded digital currency on this unified network. And that network already talks the language of global finance, like ISO 2022, what totally new stuff becomes possible. Beyond just faster payments or easier lending, think about banks instantly tokenizing assets, running complex smart contracts safely. Because the compliance is just part of the plumbing. What does that unlock? That's the really interesting question for the next episode.